Hi, this is James Zhang, and today we're going to be talking about some lessons learned from Warren Buffett from his last 2020 annual meeting. And I'm going to start with this quote: "Never bet against America." And so let's jump in. Essentially, I'm going to go through five themes and then pull out some quotes from the meeting and how they apply to multifamily investing. So, a little bit about my background: born and raised in Houston, went to school in Austin at UT. Was a loan underwriter for 8 years at G Capital, and the last 5 years have been a mortgage broker originating close to 800 million in multifamily properties, and also invested in close to 25, 26 properties across DFW, Austin, and San Antonio as a limited partner. So let's start off with the balance sheet. And Warren's Berkshire Hathaway has about 125 billion in cash right now, and their overall net worth is about 400 billion to 500 billion, just depending on how you calculate it. And so he's anywhere from 25 to 30% of his portfolio is in cash. So my question to you guys is, what is your current cash position for your personal balance sheet? And then also, what about your general partners? What about your property's position, right? So a lot of times we talk about how much liquidity a property has to sustain it. And right now you can see he's probably north of 20%, 25% of his portfolio is in cash because he thinks there is going to be buying opportunities. And so I think you should be positioned the same. So how can you get into that cash position? Number two, quote, Berkshire will never get in a position where it needs money. Our position will be to stay a Fort Knox. So, in terms of your properties capitalized, we had a call with some general partners, I think last week. And, what's a good rule of thumb for how much liquidity you should have to sort of make it through downturns? And one of the general partners threw out, 100,000 for every 100 units that you own, right? So let's say your units are, 100 units at $1,000 per month in rent. Then 50% of that is typically expenses. And so even if you had a downturn where your rents dropped, let's say your rent collections dropped by 50%, you could still cover your debt service for 4 or 5 months with 100,000. And then even if, let's say you had 200,000, then you're probably good for close to a year in terms of your debt service. And so where is your property in relation to that? How much liquidity does your property have for every 100 units? And then this last point was really around your personal balance sheet. And, Warren said people should avoid using credit cards as a piggy bank. If I owed money at 18%, the first thing I would do is pay it off. You can't go through life borrowing money at those rates and be better off. So the first thing they do in life, but don't be paying 12% to anybody. So that's the first thing he said you should be doing, is you should not be paying anybody double digit interest rates right now. And so building that foundation of cash, but then also limiting your debt. And then I've seen this. I mean, people have come to me as general partners, as limited partners, saying they want to get started in multifamily. And, multifamily is great, but, in the past 4 or 5 years, I mean, cash on cash has typically been 6 to 10%. And then maybe your internal rate of return over 5 years might be 15 to 20%, but it's not guaranteed and your money's tied up. So paying off your debt it's not as sexy as investing, but it essentially guarantees a double digit return on your money. And the last thing I would say is limit the amount of net worth tied up in one deal. Even Berkshire on this piece, it's hard for I think general partners to get over this, but I would portion it out because sometimes you just don't know what's going to happen, which we're going to get into on the next slide. Um, so the first slide was really on balance sheet. Second slide is on investments, and it's interesting because Warren Buffett's personal philosophy when he passes away, his wife or his widow is essentially directed to only invest in the S&P 500 index fund, and he is even betting. So one of the questions that they got during the Q&A was, Warren, like over the last 5, 10, 15 years, you have not beat the S&P 500 index. And Warren's comment to that was, I wouldn't bet on myself beating the S&P 500 index over the next 10 years. And his comment was really around, it is very hard with the amount of money that they have to put out to beat the index. And it's a lot easier to run a small book of business, which is how Berkshire started a long time ago, compared to a $375 billion book or $400 billion book. And so it applies to multifamily in this way. A lot of large properties, let's say 150 to 200, 250 units, that is where institutional money is being placed. And there's a lot of competition in that space. And sometimes you as an individual investor can make more money on a 20 unit, 50 unit deal than a 200 unit deal. You're competing against a different investor. Most of the smaller ones are going to be mom and pop compared to an institutional investor. And I've seen many investors who have put in, let's say, $1 million into a small property and turned their $1 million in equity into $2 million, right? So an absolute return of $1 million and essentially 100% rate of return, where it'd be very difficult to invest 10 million into a Class B property and turn that equity into 20 million. And so just thinking about in terms of size, sometimes, a lot of times people go economies of scale in terms of multifamily. And I think that works maybe on the GP/LP side, but if you're investing your own money, sometimes it makes sense to just do a smaller property. Number two, 99% of my money in Berkshire and most members of my family is in Berkshire Hathaway. And so Warren said, I care a lot about what happens to Berkshire, but that doesn't guarantee results, but it does guarantee attention. And so when you're talking with general partners, this goes back to skin in the game. How much do general partners have in their deal, right? And right now, let's say a general partner has 20 deals, but they have $1 million in one deal and 100,000 in the other deal. Which deal do you think they're going to focus on? And so really figuring out how much of GP's cash is in the deal. Number three, if you print bonds in your own currency, which is the United States, you can't default because you can keep printing money. So what you get in terms of purchasing power can be in doubt. And, the Fed's balance sheet has really ballooned. I'll show you some slides on that in a future webinar, but essentially it's gone from 2 trillion to 3 or 4 trillion, and then just in the last 2 months it's probably 8 trillion, right? So it's essentially doubled in the last 2 months with all these stimulus programs. And so the question is, are you investing in things that are protecting your purchasing power and are hedged against inflation, such as real estate? So number four, Berkshire buys 6 to 10% of wonderful companies and regards it as a partnership interest. And so as an LP, you're doing similar things to Berkshire, right? So you're buying a percentage of a property, and your job, similar to Berkshire, is to find wonderful properties and great operators. All right, third slide is really around debt. And his first comment was, we don't want to be dependent on the kindness of friends because there are times when money just stops. And so this goes back to liquidity, it goes back to cash. And then also, how willing are your top general partners willing to support their deals, right? So, in terms of kindness of friends, a lot of general partners, they might go raise money from friends and family. And now they're coming back to them right now and saying, look, we need a capital call. You put in 100,000 in this deal, and now we need another 50 from each one of you to support this deal. And the top GPs, they're going to support their deals on their own, right? So they have the liquidity. They're not going to take the management fee. They're not going to take the asset management fee. They're going to support the deal any way they can because they know that the lifeblood of their business, their syndication business, is limited partners. And they want these people to be on their team in the future. Number two is, CFOs were financing a lot of their company with commercial paper. So commercial paper typically is like a 30-day time frame, and they're trying to maximize equity capital, which is what a lot of syndicators try to do. Is they take the highest amount of debt and the lowest equity, or raise the least amount of equity so that your return is the highest, right? But his Warren's quote was, "We'll never get ourselves in a position where we have a lot of money that can come due tomorrow." So that might be 1 day, 30 days, or even a year or 2 years, right? So he has spaced out his maturities, and he chooses not to rely on short-term maturities. And so, I mean, the simple example for multifamily is, let's say you do a bridge loan, trying to extend that bridge loan as far out as possible. And then Fannie and Freddie, I mean, their loans are typically 5, 7, 10-year loans. And so you have a lot of runway so that if you do hit a recession, you're not facing that maturity. And number three, Fed came in very promptly and acted as a lender of last resort. And Berkshire, even though they have 120 billion in cash, they still went out and raised 4 billion in securities because the Fed was buying at such good rates. And so right now, I think anybody who is has maturities in the next, let's say, 24 months, 36 months, they probably should be refining right now, just to lengthen out your maturity, just in case there is another wave of this, in case the economy grows back slower. You just don't want to be caught with 3 to 6 months out, and you can't refi your deal for whatever reason. All right, cutting losses is the next slide. And the first quote is, "Know when to cut your losses." And so Warren essentially sold the top 10% of the top 4 airlines in April. And he admitted, he was like, "I was wrong. I thought, the business was in a different position. I thought it was being well operated." But essentially he had the correct operators in there. It was just the wrong business. Right. And so you could be investing, let's say, in multifamily. You could have the best hotel operators, the best hotels in the world, in the best locations, but it might just be the wrong business. And so you have to be positioned differently. He did not see a way, and they probably lost a couple $1 billion on that trade. But he was willing to cut his losses, and he admitted he was wrong. So, think about your investments out there, and if there's anything that you should just be cutting your losses and moving on. Number two, we will not fund a company where we think that's going to chew up money in the future. In the past, they spent 20 years on one business, and the problem just was not solvable. And so the chase, putting good money after bad money, if your property cannot be saved right now, and even if you injected 100,000 or 200 or 300,000, and you do not see a way to get that money back and recover that money, right? So if your property, let's say you could sell the property for 7 million now, and you put another 300,000, and it's still worth 7 million a year from now. Basically, you threw that 300,000 at that deal for no reason, except maybe to avoid foreclosure on your record. But right now, it's probably better to just sell at a loss, return the equity, and move on that deal. And then number three is, so if we have a problem business, will prefer to find someone that thinks they can do a better job of running it than we can. So if you can't solve the problem, sell it before it becomes a problem. And so a lot of this COVID has really accelerated any problems that you had in your business. If you were 80% occupied coming into this, and now you're 60% collected, you're in trouble. So let's find someone who can come in, do a better job of running it, and maybe have some capital and staying power than us. So hold period. So he doesn't, Warren says, I don't know if it's going to work out, over the next 2 years, right? Like, it's very hard. If you buy a stock today, I don't know if it's going to work out next year, but he knows it'll work out over 20 or 30 years. So you have to have a longer time frame in your mind, and timing is important, but it's just too short. If you have too short of a high hold period, it's just a lot higher risk. So model your deals out longer, 5 to 7 years probably now, versus that 3 to 5 year hold that a lot of people had. And, it goes back to a lot of what Howard Marks says also, is nobody knows what's going to happen next week, next month, next year. Fed doesn't know, nobody knows. And I think people get overconfident when they predict, and they think they do know what's going to happen in the next 6 months to a year. So focus on where we currently are, and don't try to predict too much. And you can listen to the forecast, but be able to survive long periods of uncertainty and downturns. And he says, we don't prepare ourselves for a single problem. we prepare ourselves for problems that create essentially their own problems. So whether in 2008, 2009, let's say Fannie goes into conservatorship, Lehman goes down, money markets get impacted, what's the worst case scenario? And he said, be prepared to hold a stock even if it goes down 50%, if you believe in it. So how are you modeling that in your scenarios, right? So if your collections go down 50%, are you prepared to hold that through the downturn? And I'm going to end with a couple slides that he showed. This is the first time Warren actually used slides. Um, but the Dow was at 240 when he was essentially born. It dropped in 2 years later to $41. So it was like an 80% decrease. And it took more than 20 years from 2000 or 1932 to 1951 for the Dow to recover. Right. Wow. And now the Dow is currently at 24,000 or approximately. And, we've been through a lot of difficult things here in America. And he thinks that if you bet, don't bet against America and never bet against America because there's going to be a lot of tailwind and America is going to do great over time. Just have a longer time frame, longer time period to hold. And so if you like this video, definitely like the video, subscribe to the YouTube channel. And then on the top banner, you can check or click to join the email list. And if you have any questions about multifamily financing, buying, selling, refinancing, you can send me an email and then also see all my loan closings at txmultifamily.com. Thanks a lot.